Imagine this. It's a Tuesday morning. You wake up, grab your coffee, and glance at your phone. The notifications are already piling up. Sensex crashes 2000 points. S&P 500 enters bear market territory. Recession fears loom. Your heart skips a beat. You open your portfolio app. Red. Everything is red. A week's worth of hard-earned gains wiped out. Maybe a year's worth. That tightening in your chest? That urge to hit sell all and move everything to a bank account just to stop the bleeding? That isn't a financial decision. That is a biological one. Hi, I'm Kunal from EPK Capital. For over 20 years, we've been helping families build wealth not just for today, but for generations. And today, I want to talk about the single biggest destroyer of that generational wealth. It isn't inflation. It isn't bad stock picks. And it isn't even market crashes. It's you. Or rather, it's how your brain handles fear. Today, we are going to discuss the psychology of market crashes and specifically how to stop yourself from hitting the panic button when the world feels like it's ending. Let's get the science out of the way first so we don't feel bad about it. When you see your portfolio drop by 20%, your brain's amygdala, the ancient part responsible for the fight or flight response, hijacks the system. It screams, danger, predator, run. In the savannah, that instinct saved your life from a lion. In the stock market, that instinct kills your compounding. Psychologists call this loss aversion. It basically means that the pain of losing $100,000 feels twice as intense as the joy of gaining $100,000. We are wired to avoid pain more than we are wired to seek gain. And for my NRI friends watching this, living in New York, London, or Dubai, this anxiety is often magnified. You are thousands of miles away from the Indian markets. You might see the rupee weakening against the dollar or the pound, and you think, that's it. India is risky. Let me pull my money out. But here is the hard truth that I tell my clients at EPK Capital. Your portfolio is not a scoreboard for today. It is a factory for tomorrow. And you do not shut down the factory just because it's raining outside. Now, let's look at the numbers. Because feelings can lie, but math doesn't. There's a famous study that tracks investor returns versus market returns. In 2024 alone, while the S&P 500 returned about 25%, the average investor returned significantly less, around 16%. Why the gap? Because investors tried to time the market. They got in late or they got out early. But here is the statistic that should scare you into staying seated. If you invested in the S&P 500 or the Indian Sensex over the last 20 years, you would have made a very healthy return. However, if you missed just the 10 best days in the market over those 20 years, your returns would be cut in half. Just 10 days. That's it. Now, you might think, Kunal, I'm smart. I'll just sell before the crash and buy back before the recovery. Here is the trap. The best days in the market almost always happen within 2 weeks of the worst days. Think about 2008. Think about March 2020 during COVID. The market fell aggressively, but the sharpest, most violent rallies happened right in the middle of that chaos. If you panic sold on Monday because of a crash, you likely missed the massive recovery on Wednesday. By trying to avoid the pain, you guaranteed you missed the gain. You turned a temporary decline into a permanent loss. At EPK Capital, we deal with ultra-high net worth individuals, people with liquid portfolios of $1 million, $5 million, $10 million. Do you know what they do during a crash? They don't call me asking to sell. They call me asking, Kunal, is this the time to buy? This is the mindset shift from wealth preservation to generational wealth building. When you go to a luxury store and see a designer watch or a handbag on a 20% discount, do you run away? No, you buy too. Yet, when the stock market, the greatest wealth-generating machine in history, goes on a 20% sale, we treat it like it's radioactive. For my NRI clients, I often hear, but Kunal, what about the currency risk? The rupee is falling. I understand that fear. But historically, the equity returns in emerging markets like India have outperformed the currency depreciation over the long term. If you panic sell your rupee assets when the currency is low, you are essentially locking in a double loss, one on the market and one on the exchange rate. So, how do we fix this? The next time the headlines scream, crash, I want you to follow the EPK 3-step protocol. Step 1. The 24-hour rule. Make a pact with yourself. Never make a major financial decision, buying or selling, within 24 hours of reading a negative news headline. Sleep on it. Let the amygdala calm down and let the prefrontal cortex, the logical brain, take over. Step 2. Check your asset allocation, not your returns. If your target is 60% equity and 40% debt, and the market crashes, your equity might drop to 50%. Don't sell the equity. Buy to get back to 60%. This forces you to buy low, automatically. It's a mechanical way to profit from fear. Step 3. Zoom out. Open a chart of the Sensex or the S&P 500. Look at the last 20 years. The 2008 crash? A blip. The 2020 COVID crash? A dip. The trend is always up and to the right. If you are investing for your retirement or your children's inheritance, why are you stressing about what the market did this Tuesday? Investing is simple, but it is not easy. It requires temperament more than intellect. The biggest mistake investors make is thinking they need to be smarter than the market. You don't. You just need to be more disciplined than the crowd. If you are sitting on a significant portfolio, perhaps you've recently had a liquidity event, or you're an NRI looking to structure your investments in India properly, and you want a partner who focuses on risk management and long-term compounding rather than chasing the next hot tip, let's have a conversation. At EPK Capital, we don't predict the future. We prepare for it. Click the link in the description to read more about our investment philosophy or to schedule a discovery call. I'm Kunal. Stay calm, stay invested, and let's build wealth for generations. Disclaimer. This video is for educational purposes only and does not constitute financial advice. Please do your own research before investing.